Paddy, let me ask about the current quarter. You missed estimates in the last quarter. The street was expecting more. Are they going to get it now?
Well, I think, first of all, the big event of the last quarter was, of course, the fact that we closed the merger with Generate and became the largest crude oil tanker company in the world, about 3 times the size of the market cap of our nearest peers. So there were a lot of elements in there that would have been very difficult for the street to be able to analyse and get right. But already the market has moved, and it's really turning on the back of good figures for demand. The fourth quarter looks like it's going to balance IEA expectations for the year average for growth in demand. And at the same time, of course, Iranian sanctions really biting, meaning that oil is being sourced from further away from the end user. And therefore, we're seeing US exports increasing, and that's very good for driving the distances over which our tankers sail and therefore our earnings.
OK, good morning to you, Paddy. Very good to have you with us. Let's talk a little bit about IMO 2020, because this is something that, as we look forward, is incredibly important to your industry, and you suggest to the wider energy markets and to oil consumers. So this is new rules on the amount of sulphur that is allowed to be in fuels as they are shipped.
Yes.
What impact is this having on your business right now? Do you know enough about the rules and when they're going to come in to be sure?
Well, I think there are still some uncertainties, but enough is clear. What we burn on board our ships, and it's not just tankers, but it's the whole of the shipping industry, is what the refiners know as residual oil, what we call heavy fuel oil. It's called residual oil because it is the waste product of the refinery. Now, the refiners, under national regulations, have been driving sulphur out of all the grades of their products. Aviation, trucking fuels, diesels, it's come out of everywhere. And where it ends up is in our residual fuels. So at the moment, the speed limit for sulphur in marine diesel oil for ships is 3.5%. On the 1st of January 2020, it's going to be reduced to 0.5%. This means that the last home for sulphur is being taken out of the refining market. This is going to affect the way that oil is priced. So shipping is consuming about 4 million barrels of oil a day, so only about 4% of demand, but we produce about 40% of sulphur emissions. So we're a big home for sulphur. This means oil gets regraded, not just on viscosity, not just on its various components, but now the biggest single driver for oil price differentials will be sweet versus sour.
So this sends oil prices higher, this regulation?
It sends differentials between them higher. So what it means is that the oil refiners who are cheap, who are rather easily constructed, will have to look for sweet oils. Those sweet oils will price up. And of course, they'll be able to run them and produce products without sulphur in them. But the ones that are heavy in sulphur will price down. And that discount will mean that complex refiners can buy cheap feedstock to make their products. Now, that arb between sweet and sour will drive the arb for trading oils around the world, increase demand for shipping. This is very positive news for tankers.
Paddy, what does it mean for your costs? I mean, whenever I hear about big regulations like that, and I look at a company like yours, I think it's going to cost a heck of a lot more to move that metal around the world. On the other hand, post-acquisition, you've got a lot more bargaining power with your suppliers.
Well, the cost issue has been driving a lot of analysts at the moment, because one of the rules that the IMO brought in, and I believe mistakenly, was to allow the use of exhaust gas cleaning equipment so that old dirty fuels could still be used as long as you clean the exhaust. The problem with this, of course, is that once you clean the exhaust, which you do with seawater, you simply industrialize pollution by pumping it overboard. So this looks like something that's very vulnerable to future regulation. But it's got a much bigger problem for the shipping industry, which is that it's capex in the hope of future decreased costs. Now, you may know that our industry is famously volatile, and that's because the vast bulk of our costs is in fixed capex, and we have very low OPEX, with the result that we bottom out when the market's oversupplied at OPEX and we lose our CAPEX values. So this is not a great idea. It's putting the cart before the horse to end up spending more capital in order to access cheaper costs. But I think that what we're hearing from the industry as a whole, the refining industry, is saying we haven't really paid attention to this in the past, because they very much live, as you know, hand to mouth on the margins and the netbacks that they get from what they sell. Now they're focused on it. They're saying compliant, clean fuels will be available. They've already suggested, some of the Chinese refiners, that the spread between the old fuels and the new fuels will be half what the analysts have suggested. And we believe a year out, that's going to come down even further as more oil becomes available and our costs are not materially affected.
Paddy, just briefly on Iran, Very quickly, want you to give me your thoughts. Is it positive for you that fuels are going to have to be shipped further?
Yes. So the loss of Iran, and the three big gainers for supplying the lost barrels from Iran are, of course, Russia, Saudi Arabia, and very particularly the USA. And what's important to us is that USA, because really all of that oil is going to China, so all the way around the world.